not every business starts out at $100 million in revenue with $10 million in net income. They start somewhere and gradually, maybe sometimes rapidly, grow from 100,000 to 300,000 to 500 and so forth, over a period of time.
Welcome to the Value Factory Podcast, brought to you by One Accord. We're all about helping businesses thrive and grow through leadership, strategy, and meaningful impact. Now, whether you're a seasoned executive or just starting out, our goal is to provide insights and inspiration to help you navigate your journey. Thanks for tuning in.
Welcome everyone back to the Value Factory. I am actually excited to be talking to Ed Cotney, author of Tax Freedom, the Business Owner's Guide to Tax Freedom. I'm excited because I've been reading through this book and learning things even for myself and for our own business. So looking forward, Ed, to getting into some conversation here and letting folks know a little bit more about how business owners can get tax freedom, amongst other things that you do.
Exactly, Nick, and it's great to see you today.
Likewise. But first, I have to ask, where's your office? Where's home for you?
Well, my home is just north of Sacramento, but I've got a little bit of a southern drawl.
Yeah.
I am from Alabama. We used to have a football team, Roll Tide. Maybe this year we'll get a new story for us, but last year was pretty bad. The Vanderbilt loss just killed us. But I'm just north of Sacramento. I was stationed here twice, served in the military, the Air Force for 20 years, retired, and one of my good buddies on my water ski group that I hung out with was selling his multi-gazillion-dollar business in a couple of years. And basically he was upset with the lack of tax prep he was getting for the sale of his business. And he had very reputable law and accounting firms, nationally known. And he came to me with a proposition when I retired and said, "Are you interested in going back to school and to learn how to do exit planning and tax planning?" And I'm like, "I have no idea what you're talking about. Degree in physiology, pilot, parachutist, I didn't know any of this stuff, but I had a clean slate, and he sent me off to school, and we did a great thing for him and saved him a lot of money. And so it's been a ride. That was 25 years ago, and that has just been a ride of my life.
That's an awesome story, a unique story. So one of the things that I just love about our communication, when I see your email show up, it is perfectly clear. We have one focus, because that's on your email, and that's the leading line: to show and teach you how to pay less tax for the rest of your life. Guaranteed, you say. So how do you do that?
It's an issue of education. And what we find, particularly in successful business owners, they are great at having a successful business. But when it comes to them understanding tax, they just don't do well in that arena, either for income tax planning or exit planning when they sell the business, et cetera. We put some wrong labels on our team, like our accountants and our tax attorneys and people like that. Over 80% of the accountants in the country, they're what we call tax compliant historians. Their job is to report what you did last year in order to not have an audit.
Yeah.
A small percentage of accountants will do proactive tax planning to help you do more than just fund a qualified retirement plan, show you what things to spend your money on to create an expense that's allowable. When we start getting into some of the more sophisticated advanced tax planning solutions, maybe 10 to 15% of accountants in the nation have at least a few tools to offer. And so as a successful business owners, our challenge is we have to understand our role is to understand tax and to learn about tax and to invest time and energy ourselves into learning tax so that we could pay less tax. And people go, "Well, that's just no big deal. My CPA does it." Well, let me ask you this. If you could reduce your personal income tax bill by 20% for the rest of your life, how many hours a month would you be willing to study?
Mm-hmm.
And for a lot of people, that's a decent number. And I do the same thing when they sell their business. Let's say your business is selling for $10 million and you're looking at a $3+ million tax bill. If you could cut that tax bill in half before you get to the exit market, how much time and energy would you spend learning to save $1.5+ million in taxes? So when you stop and think about it from that perspective, it's an issue of knowledge and education. And it is the duty and responsibility of learning about how to pay the least amount of tax is the client's responsibility, not the CPA, not the attorney, not the financial planner, not the business broker, and not the guy in charge of the local 7-Eleven. It's our job as taxpayers to learn how to pay the least amount of tax.
That was a point that really jumped out in the forward of your book, that it is my responsibility as the business owner to manage the taxes that my company pays and to be up to speed and to be educated about that. One of the ways, and here again, I'm going to go back to your email, Proverbs 15:22. Plans fail for lack of counsel, but with many advisors, they succeed.
Exactly.
So there's a dichotomy to what you've just said, Ed, which is I have a responsibility to manage the expenses of my business, just like I manage payroll and overhead. Taxes are an expense. So I have an obligation to manage those expenses. And yet I may not be, no, I can read your book and it will point me in a lot of great directions. We've talked about cost segregation analysis as being one of those things. But I need to find the advisors that know, and what you've just said is something that I understand from experience, that not every CPA is going to be proactively thinking about minimizing taxes for my business, in my industry, my unique circumstances, right? So how does a guy or a gal find that group of many advisors that can help us succeed? What are we looking for?
That is a great question, Nick. And one thing that I see throughout time when I ask business owners, how many times have they taken their tax returns to a different CPA every 3 or 4 years to get a fresh set of eyes to look at what they're doing? Overwhelmingly, never.
Hmm.
I trust my CPA. They're in my books up to their neck. They know everything that we're doing. And again, from a reporting point of view, they probably do. But when it comes to that forward-looking insight, what does it do? So I tell business owners every 3 or 4 years, it's worth taking your tax returns to someone away from out of town, somebody in maybe even another state, to say, hey, would you give me an independent review of my tax returns? And here's my fact pattern of what I'm doing. And let's spend an hour or two on the phone with that other CPA to say, are you doing everything well, just from a tax perspective? And at least every 3 or 4 years, when you're doing that, you can either confirm that your existing CPA is carrying the mail quite well, or discover, oh, by the way, I paid an extra $400,000 in taxes last year that I didn't have to.
Mm-hmm.
That's when you, the owner, are able to step back and go, okay, there are things that maybe some of my team doesn't know how to do. And what I try to do with business owners is to help them figure out, well, maybe sometimes you just need a specialist in one or two things to add to your team that can bring value to your CPA. And overwhelmingly, the CPAs who don't have a lot of tools to work with, whenever a nationally known expert is brought into the table to do like a cost seg study analysis, like Eric Wallace is one of the nation's foremost authorities, tangible property rules or research and development tax credits. I mean, there's all these unique nuances that are specialty driven. And sometimes you just need to bring in that expert to work alongside your existing CPA. And what I will tell you, I'll see over time is that the hometown local CPA that you're working with, and it doesn't matter if you're in a town like Chicago, New York, Seattle, or Frisco, that CPA is going to go, holy cow, I've got another 30 clients that could use this person. And so you end up with a great connection network going on. And then that CPA gets to look good in front of another 20, 30 clients.
Yeah, that's a really optimistic point. I like that.
Yeah.
So just my mind is wondering, kind of wondering about context and when these things make sense. So let's just say an operator with $1 million business and a 10% net income, $100,000 taxable net income. Effective tax rate, you can help me fill this in because I'm nowhere near a tax expert, but they might be writing a $25,000 to $40,000 check for taxes. Is that fair?
That may be a little high, but assuming there's no other income sources. So if he's going to make $100,000 a year, that's going to flow through his S corp or LLC entity to his personal 1040. But by the time you back out his deductions for single, married, joint, and the kids and stuff, he's going to have a low taxable hit. And so he's going to be recommended to do an IRA 401k, something like that. If he's got a business where it's worthy to have a depreciated truck or something of that nature, of course, you're going to do all the low hanging fruit things of expenses, things that you can do for labor cost and stuff like that. But if your total net's $100,000 a year, there's really not a lot of issues or tools that can help you really solve a small tax problem. Where we see the biggest, payoff is when we start seeing somebody with $700,000 to $800,000 a year of taxable income landing on their 1040. When you start getting up past that $300,000 to $400,000 income number, doors start opening. But when you start getting to $800,000 of personal net income landing on your 1040, there are a tremendous number of things that you could be doing. And what I have seen repeatedly happen, Nick, is that the business owner starts out in a garage or out of the car or a contract or something. They start making 100 grand, 200 grand a year, and then they're up to 300. Then the next thing you know, they've got equipment, they've got leases, and they've got a lot of things going on, and their business keeps growing in value. Next thing you know, all the low hanging fruit has been taken care of, and there's nothing else they can work with. And so now the tax rate just skyrockets. And once you get past about the 24% tax rate, which is married filing joint, almost $400,000 of taxable income, that's when you start noticing your tax cost. That's when you feel, oh my gosh, I'm 24% federal tax. And it's like a hockey stick at that point. The rate at which your taxes increase just skyrockets. And so there are these thresholds, like around 400,000 married filing joint. You have got to be proactive at that point of bringing anything and everything you can to migrate that tax bill to a lower number. But definitely 800 is another threshold where it gets really creative. And after that, it's just tons of things you can do. But for that small one, it's not a lot you can do. I will tell you the other fallacy that I see a lot of times is we outgrow our CPA, we outgrow our attorney, we outgrow our financial planner. They were great when I was starting my company. They were very helpful, got me going in the right direction. I was compliant, good tax reporting, good books. Everything's going well. But when I started making $800,000 a year, I became the only client at the entire CPA firm making $800,000 a year because my CPA has a book of business designed for business owners who make less than $400,000 a year. So, like all business owners, you're going to look at your systems and your models and you're going to go, well, how much time and energy should I spend as the business owner professional here learning about all these things I can do for my one client that makes 800,000 or my 400 clients who make less than. So you see the issue, we outgrew that professional advisor, which does happen quite often. And it's sad to see that, but sometimes we have to make those changes.
Well, that you've built the bridge to the where my mind was wandering, which is not every business starts out at $100 million in revenue with $10 million in net income. They start somewhere and gradually, maybe sometimes rapidly, grow from 100,000 to 300,000 to 500 and so forth, over a period of time. But relationships are formed and norms are created, and changing professional service providers like CPAs and attorneys, and that's an undertaking.
Yeah.
It's not insignificant. And so really the question was, where are those kind of mile markers or benchmarks and you were really clear and helpful with that. Thank you. I also was imagining that business that doesn't necessarily, maybe it's 300, 400,000 in net income. And, it's a subchapter S. So there's W-2 wages and then there's net income on the business. And maybe it's a smaller company in the trades, and they're ready to sell, they're ready to exit. And perhaps it's a $2 million sale or a $3 million sale. I imagine there are some other considerations pre-exit or pre-transition where maybe they've not crossed over this $800,000 mark in terms of net income, but they're about to have a meaningful liquidity event that could be eaten up, if not half of it, let's say, by orders of magnitude in taxes.
That is really the number one question. Most business owners will have one business their entire life, and it represents the single largest financial transaction and tax transaction they will ever have.
Yeah.
And one of the things I love about what you guys do at One Accord, because, One Accord has been a friend of mine, Jeff Rogers and John Cummins, so many others. One Accord has just been there for so many of my clients over the years. The thing I try to help business owners understand is that you need to run your business as if it is for sale every day, because it is. And the mistake that I see many business owners have is that they will go ahead and make a date certain retirement. They say, I'm going to run this business until I get to be 64 years old, and I'm going to sell it for $10 million. Okay, well, those are good goals, to have as something to strive to. But the reality is, most business owners are not going to sell when they get to that age that they thought they needed to sell the business so they could ease into retirement. They're going to sell their business because the phone rings and the phone call goes something like, "Hey, we've got people interested in buying your business. We think your EBITDA is going to be this number. And would you be willing to sit down for a talk for us to get your business listed? Because we think we've got some buyers." That is how this whole process starts with most sellers. And sadly, at that point, if they have not been doing the work that they need to do to build the equity value, the enterprise value, whatever you want to call it in your business, they're going to go to market with a lower number. They're going to have a smaller EBITDA. They're going to get hammered in taxes, and they're not going to be prepared for the transaction. And that's why I love what One Accord teaches. It teaches you to get ready for this transaction. The one thing I try to advocate, in addition to these fundamentals that you guys teach, is if I'm running a business today and I have a target of selling in 3 years or 10 years or 5 years, one of the things you can do to start learning about your exit is how to play the tax game. And the reason I think this is important is because when you do get into the point of selling your business, LOIs, PSAs, and all this other stuff, due diligence going on, you're in the last 2, 3, 4 months of this whole process. And then somebody says, "Hey, have you thought about reducing your tax bill a little bit to help out on this?" You're not going to have time to be learning about tax strategies. There's tons of strategies, and every strategy is not for every business. And so you have to look at the nature and character of the business. You have to look at what the seller's post-transaction goals are going to be. All of these things come in to predicate what would be the right tax solution. So what I try to get business owners to do while they have time to have control and comfort, let's go ahead and run the process of you selling your business next month for $10 million. What's it going to look like? What's the tax bill going to be? Will the net proceeds minus commissions, taxes, fees, and everything else be enough for you to hit your target goal to retire? And if you start getting ugly numbers and answers, you start going, "Oh my gosh, this ain't good." The other mistake that I see business owners do is they'll go out and order an appraisal. I beg of you, never, ever, ever order an appraisal. Have your attorney order the appraisal. This way it's protected under attorney-client privilege. And here's the reason why. If that appraisal comes back and it's a disaster, you don't want anybody to see that thing. And so since it's under attorney-client privilege, when due diligence get here, it's not going to be submitted to the buyer to see. You take that bad report, you figure out what's going to be done to fix it. And then when your business is running real pretty and you've got a really nice appraisal, print out an extra 100 copies and stand on the local street corner and pass those things out to anybody walking up and down the street. But the bad appraisals, which sometimes can happen, we need to protect and keep that to ourselves. The other thing that I see mistakes in appraisals is we don't ask the appraiser to separate or bifurcate what we call the goodwill. Almost every business has a component of goodwill in the sales character. And sometimes if you have a personal or tangible component, in addition to the corporate component, not a lot of tax things you can do with the corporate component. There are several really great things you can do with a tangible or personal component pre-transaction that can net you 2, if not 3 tax benefits. And so I will always tell my clients, demand that the bifurcate goodwill into tangible and corporate. And if we come back with a decent sized number on a tangible one, like say $2 million of your $10 million transaction is deemed as a personal or tangible goodwill, holy cow, that gives me a lot of stuff to work with, which you're going to be totally happy about. So there's little nuances that you need to know well in advance of shaking hands with a broker and signing an exclusive agreement to sell your business. And it's all about what you guys preach. Get your house in order.
Yeah.
I'm just advocating get your exit house in order to know what the tax bill is going to be and how you can make that tax bill as small as possible. Because the thing that happens, if I go into a $10 million transaction with no tax planning and I know I'm going to lose $3 million and I'm going to go home with 7, when the buyer comes back to the table and offers 9.5, I don't have any wiggle room here. I need that 7 million net of tax. Whereas if I've got a good tax plan where maybe my tax bill is only going to be $1 million, and I'm going to go home with 9 in some form or fashion to work with and take care of me, that gives me about a $2 million buffer that when the buyer comes back and says, "We think your business is worth 9.5, here's our offer." And instead of you pushing back because you have to have more than 7, you're ready to deal. You're in control.
You've made this really kind of easily consumable, Ed, and that's a gift. You're walking through some ideas that I think have a lot of complexity, but I can track with you. So I'm thankful for that. I'm thinking of so many things. First of all, grateful that we are aligned in some real kind of tactical things, like don't get an appraisal direct, have the attorney order that. What we find is in engagements where someone's gone to market and they've been unsuccessful in selling, either the investment bank, the deal was hung, or they just couldn't get an investment bank to represent them. Unfortunately, some folks come to us already having completed that appraisal process, which, cool. We're going to demonstrate that from here with this valuation based on these things, we've fixed a lot of those. And that's why the value is higher. It's substantiated. That process for us is generally 18 months. I'd like to say we could do it shorter, but 18 months is aggressive. 2 years, but 3 years. In that window of a year and a half to 3 years is about, we have to demonstrate through a couple of annual cycles that that the trend is not just a bump, that operational efficiencies that we've run through a couple selling seasons, if there's cyclicality in the business, we have to do the thing, and then we have to prove it. When it comes to tax strategy, how far in advance of that exit, that transaction, how much time do we need? If you're talking to me as the owner of One Accord, which, you are, and in this context, Nick, if you're going to prep for a transition, you need how long?
Minimum 2 months. And you're not going to like it.
That's pretty fast, actually.
And the problem with 2 months is there a way to mitigate some tax on a transaction? 2 months. Nowhere near as good a solution set had we had a call 2 years prior. 2 years prior, we have tons of tools to work with that will align beautifully to give you maximum tax benefits. But when it's like, hey, we're closing in 13 days and we need a tax miracle, you've only got 1 or 2 hammers, and you may not like those hammers. So I agree with your assessment that early on, you should be looking at what would my tax exit look like. For a lot of business owners, they really don't know the value of their business. They've never stopped to go, if I sold today, what would my business be worth? I tell business owner all the time, you need to know today what your business is worth, because if you're killing yourself working so hard, wouldn't you like to know that you're building value in your business with this current lifestyle that you're struggling with to make ends meet? Is it worth it or not? And we get it with things like all the time. In my next book, the Tax Smart Business Sales, I have a study where one brother died, another one was in a divorce being sued by his wife, and the other one, lost a whole bunch of money gambling. I mean, all of these things become players in the overall exit strategy of business owners when there's 2 or more sellers. But I agree with you. If you can get in there, I'll try to get people 2 years prior. Let's look at what it would look like. And this way they now know, okay, I need to be increasing EBITDA because I'm not hitting my numbers right. I know that this is my ramp time for the next 2 years. It kind of gives them that fuel at that 2-year mark to get serious about it. And again, they may not sell in 2 years, but they could be selling in 6 months because of that unsolicited phone call of, hey, we've got a buyer and we think that yours is the perfect business.
Now, I bet that you and I could align on this idea. It's a fresh idea, just came to me in this conversation, and I'll just say, transparently, my plan here with One Accord includes a couple of milestones, mile markers, or destinations, let's say. And a part of that is a transition to partner ownership beyond Jeff and me. Jeff and I own the company together. I'd like to bring in more partners by way of selling, a partner buy-in. Okay. And then at some future destination, I'd like for all of us to enjoy a liquidity event by taking on, let's say, private equity or a strategic alignment where we would still retain some ownership, ideally. This is the way my spreadsheets, I joke and say I have beautiful spreadsheets, Ed. If things happen the way in real life they look like they're supposed to happen on the spreadsheets, life is beautiful. Okay. So let's say that's a 10-year plan. Getting to this idea, wouldn't it be neat for guys like you and me who want to serve those clients like me with a 10-year plan? Wouldn't it be great if we just met once a year for 3 hours, not that 4 hours? And we had kind of the team, right? That group of advisors that Proverbs encourages us to surround ourselves with just once a year, in year 10 and 9 and 8 and 7, as we count down so that as far in advance as possible, I can be thinking about, well, how do I want to, what's the right entity type to have the business in if we're going to transition? Where do I hold real estate assets? How do I, what do I need to do with my financial statements that I'm going to have to turn over to someone? At what point do we stop running some seller discretionary expenses through the company, or do we properly account for those so that quality of earnings is really clean? And right. So the idea was, wouldn't it be great if every owner kind of brought together their advisors, and even if it was 10 years out, just met? Do you think once a year is frequent enough?
It is. Once a year will work and is needed. I have several of my clients who have very profitable businesses, and we ask them to get together with the team. And it's really funny when you get to go to these team meetings to get to see the client meeting face to face with the attorney, the accountant, the financial planner, the real estate guru. Everybody's in the same room, and the business owner, the client, gets to say, where are we at with the objectives I laid out last year?
Hmm.
You know, and everybody gets to share in an open area. And then the client is able to articulate to the team in one place, this is where I'm going next year. I need you guys to get on board and go with me. You're so absolutely right, Nick, to get people together at least once a year, even if it's through video conferencing systems, once a year, so that you can see that face, ask those questions, have that interaction, see the other team members, because they do change every now and then. I mean, people retire, they die, they leave, they move, etc. But
Yeah.
to be able to see that team and to know that I have permission to talk to those team members, that's one of the things I tell a lot of clients, that you've got to really make certain you're writing herd on these advisors, because some of them have a duty not to share any information at all, like the attorney-client privilege. That's a big one. And that attorney will sit there and say nothing until the client says, I'm giving you the authority to share this information with my other teammates to get the best outcome. And we need that attorney to sit there and say nothing till they're given permission. We don't use our attorneys properly in this country. We need to use them better.
Let me ask this in a closing thought, and hopefully we will continue this conversation, because there's a lot of really good stuff here, Ed. Closing thought: who should be on that team of advisors surrounding the business owner?
Number one, the business coach.
Okay.
You got to have a business coach, and that business coach has got to have some acumen both about the business and how to be the best business owner person possible. I mean, if you can't be happy at work, I don't care how much money you're making. You got to find that bridge between these two things, which is why I love business coaching organizations. They're just so helpful. The attorney is needed, preferably one that's a business oriented, focused attorney, preferably one that's worked with exit planning strategies. The estate planning attorney is sometimes needed, especially if the estate is going to be subject to estate taxes, because there's a lot of moving things there that you want to be planning for. Obviously, the accounting team to be able to understand where they're at and what they're doing. It's always good to have the financial planner there. They will have some tools that can bring some benefit to the table, but their broker dealers really keep the financial planners kind of in a narrow lane. They don't get to talk about anything that they're not allowed to talk about, which is kind of sad. Getting tax strategy people involved with both your income tax planning and your exit planning for one day. And it's amazing. I mean, last year I worked on $2 billion plus projects. And I'm looking at what the client had been doing the previous years. And I'm like, oh my gosh, look at how much money they overpaid in taxes. I mean, no, the ship was so big, nobody knew how to make the ship do anything different than just let it go. And I'm like, wow, misinformation is one thing I'll share as I know we're closing up. I did some lectures last year in Nevada where I was talking about the new rules on C corporations from 2017, probably the most misunderstood, fantastic tool we've had in years as a C corporation since 2017. The new tax bill for this year, the OBB3 that they're calling it, it is very nice. It's good. I like a lot of things that have been done in the new tax bill. Most business owners are going to like it. I do see some improvements coming in year two. We need to see a few things happen on the C Corp rules to make us more competitive globally. The United States is not the best place to have C Corp funding. There's still many other countries where if I'm operating legally and I can have a C Corp in another country, that's where I put my money. The United States is just not competitive yet, but it's still better than what it used to be. But no, you're right, Nick. It's about putting a team together that you can trust and depend upon. That's crucial to have when these big events get here, like selling your business.
Yeah, so good. Well, once again, everyone, Ed Cotney, author of The Business Owner's Guide to Tax Freedom. He's got more books on the way. Ed, what's the easiest way for someone to find you if they want to reach out and learn more?
Just olympustax.com. My website's there. There's a lot of really good articles on there about exit planning. You can spend hours upon hours just reading, print anything you want, have a good time. The book, of course, is available at Amazon. All proceeds go to the Salvation Army. We try to have all the books set up where all proceeds go to charity. And the next book, we haven't decided which charity is going to get that. But we also wrote a avoiding deal disaster checklist. I just sent you the newest version of that one.
Yeah.
Feel free to share that. It's got 7 little quick points about things you need to be thinking about if you're owning a business today.
Wonderful. And I appreciate, Ed, you sent me about a dozen copies, 15 to be precise. Now, I'll give 14 of them away because I'm keeping this one for myself. It's a great read, really, to inspire the thinking that I want to then go kind of chase down some of these opportunities well in advance. Ed, thanks so much for being on the Value Factory. Look forward to having you back. This is a great conversation.
Anytime, Nick. Enjoyed it, sir. Have a great day.
All right.